Tom Lee, Bear Market. Coming in 2026, why it's a buying opportunity. In 2026, markets could drop as much as 20% and still be in a powerful bull market. That's the core message from Tom Lee, co-founder and head of research at Fundstrat Global Advisors, and one of Wall Street's most persistent bulls over the last decade. In a recent interview on the Master Investor podcast, he laid out why a sharp drawdown this year might be the best buying opportunity investors see for years. Tom Lee believes the current equity bull market actually began back in 2022 and could run for a full 10 years. But he also warns that 2026 will be bumpy, with a drawdown that feels like a bear market, even if the long-term uptrend stays intact. He talks about a peak-to-trough decline somewhere between 10 and 20%, enough to scare investors and potentially take the market back to flat for the year before a strong recovery into year-end. The key point, he sees this not as the end of the bull, but as a reset within it. And every major pullback so far has turned into a great entry point for long-term investors. What could trigger that painful correction? Lee highlights three big transitions investors must navigate in 2026. First, a new Federal Reserve. Markets almost always test a new Fed chair. In the process of nomination, confirmation, and policy, uncertainty can create volatility and corrections. Second, a more interventionist White House that is increasingly willing to pick winners and losers across sectors and even countries, adding political and regulatory risk, something he says you can already see reflected in gold's rally. Third, a market still trying to figure out how much of the AI story is already priced in. Questions around energy demand, data center capacity, and the durability of AI growth can all destabilize sentiment until new narratives like a recovering ISM or housing upturn take over. Together, he thinks these three forces can produce a drawdown that feels like a bear market without actually ending the structural bull. Despite the expected turbulence, Lee still likes the so-called Magnificent Seven megacap tech names. He believes their earnings power remains strong, and as long as profits keep growing, these stocks can continue to outperform the broad market. But for 2026, his top sector calls are different: energy and basic materials. He points out that energy and materials have badly underperformed over the last 5 years, to levels that historically have marked turning points over the past 75 years. He expects improving manufacturing data, Fed rate cuts, and geopolitical dynamics to support cyclicals more broadly, including industrials, financials, and small caps, potentially making them the more interesting trade than just crowding into U.S. megacaps. Interestingly, Lee is not especially bullish on near-term oil prices, yet he's bullish on energy stocks. His reasoning: energy equities discount future oil prices, not today's spot level, and structural demand from data centers and a shift away from some alternatives could support higher long-term pricing even if the short term is choppy. In basic materials, he thinks gold has already had a big move, but believes silver and copper could have particularly strong years ahead. Copper, in his view, is tightly linked to industrial activity in the ISM. If global manufacturing picks up, copper and related equities could lead higher. Financials are another area he still likes even after a strong run. He argues that banks have invested heavily in technology and AI, and because compensation is their biggest cost. AI-driven efficiency could lift margins and make earnings less volatile over time, potentially justifying valuation multiples closer to technology stocks than the traditional 1x book benchmarks of the 1990s. On the macro side, Lee's message is that the inflation scare is largely behind us. He cites measures like true inflation and median inflation, both running around 1.8%, and notes that housing, the component keeping official inflation elevated, is already softening in real time, but appears in CPI with a lag. That, he argues, gives the Fed cover to cut rates, which could ease mortgage costs and consumer installment debt and relieve pressure on households. At the same time, he acknowledges political pressure on the Fed and investigations that could threaten its independence, but thinks there are still enough voices in Washington that do not want to undermine the credibility of the central bank. His base case is a rate-cutting environment that supports risk assets rather than chokes them. When it comes to defensive assets, Lee believes gold is still underowned. He references allocators like Ray Dalio, who have suggested 10% in gold, and even mentions a 15% allocation guideline he has discussed before, while pointing out that most investors are effectively at zero. One striking claim is that Tether, the largest stablecoin issuer, has become one of the biggest private buyers of physical gold, using the excess yield from its reserves to purchase bullion, and possibly being outpaced by only a single central bank since mid-2025. In parallel, he still sees Bitcoin as digital gold with a higher future adoption curve than gold itself, despite an October deleveraging event that broke its tight correlation with the metal. For 2026, he sticks to a bold Bitcoin price target of $250,000 and remains constructive on Ethereum as his favorite cryptocurrency, especially as banks and asset managers steadily adopt blockchain rails. Lee is also cautious and optimistic at the same time on AI. He estimates that maybe only 10% of AI-related stocks will end up being good long-term investments, similar to the tiny fraction of internet companies that survived after 2000. Yet, just like the internet era, the small group of winners can still massively outperform the broader market. He sees more AI companies coming to public markets as capital rotates out of private alternatives, and he argues that today, hyperscalers and chip leaders could eventually be viewed more like staples with durable earnings, not just cyclical hardware plays, which could justify premium multiples even as growth slows. In his framework, the message to investors is clear. Accept volatility, expect a scary drawdown in 2026, but treat it as a chance to accumulate quality equities, cyclicals, gold, and crypto within what he still believes is a long structural bull market.